Welcome, everyone. My name is Bill Giffin with HTTC Wealth Partners. I want to thank everybody for joining us today for our conversation with Stephanie Link. Before we get started, I do want to mention that on the side of the screen, there is an opportunity to ask questions. If you click on that, you can text questions, and then after and during our conversation, as those come up, I'll try to incorporate those with the conversation with Stephanie. First, I hope everyone's having a nice summer. It's been a pretty special summer for us at HTTC Wealth Partners. We've just celebrated our 30th anniversary as a company. And so I wanted to mention that, and first and foremost, say thank you to each and every one of our clients, our employees, and our partners. We feel as if over the years, we've created something very special. In addition to that, as you're all well aware of, we've created a partnership with Hightower Advisors over the last couple of years. And today, because of that, we have the opportunity to have Stephanie Link join us for a conversation. One other comment I do want to make, which I'm very excited to be able to mention, is that also we have a new partner that joined us earlier this year in EF Wealth Management. This is a company out of Schaumburg, led by Tom Alexa and his team. They joined us in February. This is a group of extremely talented individuals that focus on wealth management and life insurance, and they are incredibly good at what they do, but more importantly, they're better people. They stand for exactly what we stand for, and that's integrity, hard work, honesty, and serving the clients to the best of their abilities. So we welcome them, we welcome their clients, and we look forward to getting to know you and working with you along the way. I know many of you have seen the markets over the last 6 months. Stephanie Link has joined us today. Stephanie is our Chief Investment Strategist for Hightower Advisors. Prior to joining Hightower Advisors, Stephanie served as Senior Managing Director and Head of Global Equity Research at Nuveen. She also served as Chief Investment Officer at The Street and co-portfolio manager of Jim Cramer's Charitable Trust, and Managing Director previous to that as Institutional Sales and Director of Research of Prudential Equity Group. She has 27 years of experience managing money. Stephanie's insights are frequently sought out. You've probably seen her if you've watched CNBC. She contributes to the Halftime Report, Closing Bell, and Squawk Box. I've had the opportunity over the last couple of years to get to know Stephanie, and I will say, in all sincerity, every time I walk away, I've learned something else, and I've had the opportunity, majority of the time, to share with the clients that we work with here. So Stephanie, welcome. Last time we were here, you said we'll report back in 6 months and see where we are. And so here we are. So thanks for joining us. Really do appreciate it. Always welcome the opportunity to spend some time with you.
Thanks so much for having me, Bill. I'm so excited to be back, and congratulations on 30 years. That's amazing.
Yes. 30 years, Hightower, 15 years.
That's great.
Pretty amazing.
That's terrific.
Maybe we start with the conversations we spent most of our time having 6 months ago, and that was all around the Federal Reserve, that was all around inflation. And so, the questions back then were, hard landing, soft landing, deep, shallow, long, short. So kind of as we look at it today and moving forward, how do you see that from a standpoint of soft or hard landing?
It's been an interesting first part of the year for sure. And I think right now we are in a soft landing patch. And what I mean by that is everything that we're seeing, the data, we can go through it, but all the data really is supportive of kind of low GDP growth, 1 to 2%. Not a recession, not a hard landing, but what we are very mindful of is that the Fed just raised rates for the past year by 525 basis points, and they're about to raise rates again today, this afternoon. And there's a lag effect, right, of about a year. So they started a year ago. We're starting to see some signs of slowing, but so far there's enough momentum in the economy that we're able to handle it. And what do I mean by momentum? Well, we had 2 stimulus bills in the first quarter that were passed for the more of the onshoring theme and building bridges and making America, fixing all the various different infrastructure issues that we have, and that's created a lot of stimulus. And it's almost, it's not outdoing what the Fed is trying to do in terms of tightening conditions, but it's offsetting. And in addition, the U.S. consumer has been resilient, absolutely resilient. The reason for that is because wages are, wages are high, but also jobs are plentiful, and that's why wages are high, right? If you look at a lot of different metrics, like the non-farm payroll numbers, you look at the Challenger Gray layoffs, they actually declined last month by 49%. Initial claims, I kind of look at on a 4-week moving average, and that number, it's a forward-looking indicator for jobs, and that number remains very, very low, at about 253,000 initial claims, weekly initial claims, if you average it together. Just per perspective, in a recessionary environment, that number would have to get to something like 350,000 to 375,000. So we're at initial weekly claims at a very, very low level. And of course, there are 1.6 jobs open for every one unemployed person. So any way you look at it, any data point you look at in terms of jobs, the job market is very tight. And as a result, you've seen wages be elevated, and they remain elevated. It's anywhere from a non-farm payroll number. They have an average hourly earnings number that came in last month at 4.2%. The ADP number, wages came in at 6.4%. And if you switch a job, the ADP number suggests you can get 11.2% wage growth. So you can get a job if you want a job, and you're going to make more money if you do have a job. And unfortunately, that has led to inflation being really pretty sticky, even though we've made progress. But across the board, we care about the consumer because it is 70% of the US GDP. And where the consumer is spending is in housing, autos, also in services. And services is 75% of US consumption. So we root for services, we root for the consumer, and that's been a really nice tailwind for the economy. The weak parts of the economy is manufacturing, and we get all kinds of data that shows that manufacturing is in contraction, but there are certain pockets within manufacturing that are starting to see signs of life. The rails, the transports, onshoring, as I mentioned, and we get regional manufacturing data, and they seem to have bottomed. It's still in contraction, but it's a little bit better. So you add it all up, and there is this thing called it's a little wonky, the Atlanta Fed GDP Now. All it does is it takes all the data I just mentioned, and it sticks it into a model with no opinion, and it produces a number of what GDP looks like based on all of this data. And it's suggesting that this quarter is running at about 2.5%. So again, not a recession by any means. And of course, this has led to better than expected corporate earnings and better cash flows. So for now, Bill, we're okay, right? We've got to do this again in 6 months, because in 6 months, I might be talking a much different story, because we might start to feel what the Fed has done. But for now, it's kind of Goldilocks.
Yeah. And do you think, you mentioned expected rate hike here, and you saw the pause in June. After this, do you see another pause? Do you anticipate anything else moving forward in the next 6 months or so?
It's hard. Like, I hope they don't go anymore, because we all know 5.5% Fed funds rate is a very high number, especially relative to what we've seen over the last 10 years. So I'd like to see what the implications are of these really aggressive tightenings. So I think they go 25 today. I think the language will be, we're going to be data dependent, and maybe they pause next month. Maybe they go one more time. I think the point is we're in the 8th or 9th inning of them raising interest rates. So that's the good news. The bad news, they're probably going to keep it at this level for quite some time. And that's because of really sticky inflation. And we've made progress on inflation. Last year, we had a CPI, Consumer Price Index, of 9.1% in June, and it's fallen to 4%, the most recent reading. The problem is that when you exclude food and energy, which is what the Fed likes to do, because those pieces are very volatile, they call that the core, as you know, and that number is at 5.3%. They want that number to be 2%. So that's why I say the Fed may be done or getting close to done, but I think they're going to keep rates high for a long period of time. and we'll have to just kind of wait and see. And we're all going to be data dependent.
Yeah, and in regards to data, and you mentioned it earlier on the consumer and the strength of that right now. How do you see that moving forward also?
Yeah. Well, I think we have to watch jobs seriously, because that is really the one piece that, it feeds off of itself. It's not only that you have a job, you're making money, right? But then your confidence goes higher. And when you add on asset prices like home prices, look at the stock market, look at the bond market, people feel better. In fact, we had the highest consumer confidence number yesterday that was reported in 2 years. Well, no one was expecting that in terms of at the beginning of this year. We all thought that certainly the Fed was going to have their implications were going to be that they slow down the economy. They just haven't been able to crack the job market, and I think it's going to take a really long time for them to figure out the job market, because you have some people that never came back into work after COVID. You have the immigration policies, that's definitely a headwind, and so you have a much smaller pool in that's out there. And I listen to companies all the time. I know you listen to companies too, right? They're telling us it's hard to find people. Well, yourself in your own business, right?
Yes.
So,
Stephanie, I tell my children their jobs out there every day.
Yeah. They should be so lucky. I mean,
exactly.
it's not always this easy, that's for sure.
Exactly. All right, so let's shift to the equity markets, and before some comments there, I think for the audience here, I think one of the nice things about Stephanie, as she looks at the economy and conversations, and you see her on CNBC, she actually manages money every day also. So she is in the trenches doing this every day. She does this for our clients here at Hightower. She does this for our clients at Hightower TC Wealth Partners. And so I just want to make sure that in many instances, this is somebody that's on the field every day, seeing this stuff every single day. So I guess one of the interesting things, Stephanie, if you look at the first half of this year, is really how concentrated the market has been with specific companies. And kind of, what do you think kind of drove that? And what are your expectations as we move into, and we're in it, the second half of the year?
That's right. Yeah, no, I will tell you that's been the biggest surprise. Not only has the economy hung in there, which is one surprise, but it's also the fact that it was so narrow, the market. And I think a lot of that, and narrowness meaning the top 10 growth and technology stocks accounted for 90% of the returns. So that's really narrow, and that's
a huge number,
right? Yeah. And that's not healthy, right? So I think what was happening in the first half is people thought that we were going to see a big slowdown, and that we were going to tackle inflation. The Fed would not only stop raising interest rates, but start to actually ease interest rates, right? And so I think people wanted to. When you see low growth, but believe it or not, you know this, when you see slow growth or even a recession, you look for growth stocks that can grow in any environment. And you know what? Technology, the total addressable markets that some of these technology companies have available to them is so powerful. And then add that on, in March, we had this AI craze. And if you believe McKinsey, they think that AI is a $4.4 trillion total addressable market by 2030. I mean, 2030, that's right around the corner. Yeah. So I think people wanted to have exposure not only to the social media names, but also to AI, data center, anything tied to AI, right? Cybersecurity also is a very big theme, and we hear about something, terrible news every day about breaches. So there are these powerful themes I think people kind of like grasped onto, which I understand. I think it got a little carried away. And then as you've been seeing the market the economy actually hanging in there, and earnings are actually coming in a little bit better, that's actually in the last couple of weeks, Bill, we've been seeing a broadening out in the marketplace. Yeah. So it's not just the top 10, and it's not just growth, or it's not just technology. And again, if you think that rates are going to stay higher for longer, which I do, you don't really want to have long duration assets. And by definition, technology and growth stocks are long duration assets. So I think you've seen this broadening out into other sectors. And that's where I think the real value is in the equity markets. It's these other sectors like industrials and energy and financials. You could still own technology. There's still a lot of exciting things happening there, but I do think you can actually be more diversified.
Yeah, and that's actually where I was kind of going next, really, as you look at those other sectors and you kind of look at the themes and things of that nature. Are there any specific areas that you're really kind of digging a little bit deeper into right now?
Yeah, so I mentioned the consumer. I definitely want to have exposure to the consumer. People tend to want to worry about the consumer and say, even if we go into a recession, they'll say, well, the consumer is going to stop spending. Bill, we are a nation of spenders. You know that, right? Whether they have money in savings or they take on debt, we are always a nation of spenders. And I think that will remain the case. Within consumer, I think housing really makes a ton of sense. So just a couple of stats on that. New home sales are that were reported this morning actually rose 24% year over year. You're back to levels that we haven't seen a year ago in new home sales. Now, existing home sales, that's a problem, and that's because nobody wants to take on a 7% mortgage rate when 85% of the country has a mortgage rate below 5%. Right. So there's this little dichotomy happening in housing, but I do think you want to have it. You talk to any home builder and they will say, well, we've underproduced for the last 15 years. So the market will stay tight even as rates go higher. You have 5 million millennials that are just entering into the home market for the first time. They're leaving the parents' basement and they're going out and trying to find a job. They have a job, they have wages. Now they're looking for homes. We have 5 million homes that we're short in this country. And as of the last data that I read, there 74% of homes sold last month. The house was on the market less than a month before it got sold. That's 74% of the homes sold. That's crazy. I mean, crazy. The housing market is really one that I like a lot. I do think energy makes a lot of sense. I think the supply demand dynamics are very powerful. And in particular, I like the oil services companies because they implement a lot of technology in their businesses, and so they have pricing power. I think the onshoring theme that I mentioned, I think that's a 10-year theme. We just are starting to get going in really building out manufacturing plants and that sort of thing as companies look to diversify away from China and to create supply chains, not only here, but also in India, Japan, Europe, et cetera. I think the aerospace industry is extremely interesting. There were a couple of companies that reported earnings yesterday that were just, blow away numbers. And the reason is because you have kind of a duopoly with Boeing and Airbus, and they have 16,000 planes in a backlog. That's just crazy. So the visibility is really there, and it does tie directly into international travel and global travel that has picked up post the pandemic. I like the financials a lot. I think that they are very cheap and their capital levels are very strong. And it's interesting, within financials, I like capital markets because, and it's interesting because the CEO of Morgan Stanley was on an interview in CNBC last week, and he basically said he thought that capital markets bottomed 4 to 6 weeks ago. So you're kind of troughing in capital markets, and I think that's an interesting place along with the valuations. And then I like China. I am kind of in the minority, I realize, and the reopen has been much slower than I have expected. But the one part of China that I like, and the reopening theme, is really the consumer. So it's really tied specifically to the consumer. And if you listen to Hilton, you listen to Las Vegas Sands, you listen to a lot of these companies that have businesses over in China, they've actually started to see a pickup. And so that's sort of interesting to me as well. And I also think that they're going to have to stimulate their economy. Meaning we're going the opposite direction, right? We're tightening the standards and we're tightening financial conditions and we're raising rates. And I think China's central bank is going to have to lower interest rates, and that will help stimulate their economy. And I think they will be able to do about 5.5% growth in GDP. Again, I think led by the consumer. So those are a couple of areas that I'm focused on.
That's interesting. Okay, thank you. And you mentioned real estate, and so let me shift a little bit to maybe commercial real estate, right?
Yeah.
And then even in combination with that, what we saw happen, I think, since we spoke, right, with the banks.
Yeah.
Right. And so curious, do you feel like that has broader implications? Where are we along that path right now?
Yeah, I mean, it was a little dicey there in March, right?
Right.
We had a couple of bank failures. With three notable ones: Silicon Valley Bank and Signature Bank, and then CS First Boston. I will say, CS First Boston has been in trouble for a long time. It's been many, many years, so that didn't surprise me as much. But what happened is, first and foremost, Silicon Valley Bank didn't even have a risk officer. That's number one. Number two, they were very tied to venture capital, and that's number two. So very concentrated. And number three, it has a lot to do with our phones. You can now change any bank, and you can just by a push of a button. You can change where your deposits are going, and so the speed of which things happened to that bank was unfortunate. Signature Bank had a lot of issues tied to crypto. They had a lot of exposure there. So I'm not just saying like, okay, it's just those three and nobody else is in trouble. There have been 519 bank failures since 2009. Bank failures happen. We have 4,000 banks in the country, and the big ones are getting bigger. And what happened is because interest rates rose so quickly, well, people took their cash and put it into higher yielding instruments, right? So that's exactly what happened. That's called cash sorting. Well, it really hit its peak in, I think it was April, May, in terms of seeing this cash sorting. And it was interesting because the CEO of Schwab, again on TV last week, talking about how this speed of cash sorting actually has slowed down. So that's good news.
Yeah.
So we're seeing, we had an interesting acquisition overnight with PacWest and Bank of California. They're merging. So I think you're going to see more mergers in the regional industry as they try to figure out all of this. But I do think the big banks get bigger and they gain more share. And that's where I would kind of lean towards in terms of being on the investment side. In terms of commercial real estate, structures investment is only 3% of GDP. And only part of that is the problem. So I think if you have exposure to B and C properties, you might want to be a little bit more diligent on the exposure, which in terms of which companies have that. Wells Fargo actually said that they have about 14% of their loans is commercial real estate, but most of it is A properties. Yeah. And so they feel like it's manageable. There's no question we're going to wake up one day and someone's going to have a problem. Absolutely. Maybe it's a couple of them, but I do think, again, it's kind of, it's tied more towards the regionals. And I just don't think the regulators are going to let these banks fail. I think they're going to either make sure that they find a partner, or they might ask a large bank to come in and save the day, like JP Morgan and First Republic. Right. So we'll, I think it's manageable, but I do, like that's something that does keep me up a little bit at night, just to watch it and monitor it.
Okay, thank you. And, as you mentioned yield earlier too, as we let's shift from the equity markets for a second and look at fixed income. Yeah. And, obviously the inverted yield curve and where we are right now from a standpoint of yields and even, yields on cash right now. What's your thoughts in that environment currently?
Well, I will say for the last 10 years, minus this year, there was no alternative to finding yield, right? Because the Fed kept interest rate at zero. So as a result, it forced people into the risk assets, which is the equity markets and dividend paying companies, because you could get yield. So fast forward to this year, now with a 5.5% Fed funds rate, there is an alternative. There are a lot of alternatives. And I'm sure you have had these conversations with your clients about that. Like, why wouldn't you want 2-year paper and at 5%, right?
Right.
4 or 5.
Exactly.
Or corporates, you could get even higher if you're willing to go down the credit spectrum. So there was this massive like shift from 100% equities, 0 bonds, back to the allocation 60-40, right? And so I can't dispute it. I can't disagree with it. I totally get it. Why not 5%? You can call it a day. But I don't think you want to give up on equities, because over the long term, the total return for equities is 7%. So it's even better than what you're getting in the bond market. But I definitely think the diversification is real, and I think there's absolutely a place for it and a need for it. And as I say, I'm sure your clients have you've been talking to them about this too. A lot of different alternatives, right?
Right.
Yeah.
At least there's alternatives now, which there wasn't before, as you mentioned.
That's right.
Correct.
That's right.
Yeah. Okay. So there's a few also questions on. Okay, please speak to the drug industry. Is it true government policy is affecting production?
Well, I think that the government is always kind of affecting, and by the way, both sides, both Republicans and Democrats. It's not political at all.
Right.
I do think that, I think that there's definitely concerns about it. And by the way, that's raising prices as a result of it affecting production. And so, and oh, by the way, the pharmaceutical industry is the largest lobbyist group in the country in all sectors, right? So in Washington D.C., and so they definitely have ties with the government, but they're struggling and fighting in terms of how to get things done and to have a smoother pipeline and production. And so, by the way, you are seeing a lot of these companies also start to build manufacturing here in the States and everywhere else too, but here in the States, which is the first time you've seen that in a long time. And so, I think it's a struggle. I think it's one of the many reasons why the pharmaceutical industry, trades at a very cheap multiple. But at the same time, Bill, they have great dividends and the balance sheets are terrific. So that's another place you could probably kind of park your money, not expecting a lot of appreciation in terms of the share price, but at least dividends and shareholder returns in terms of buybacks and that sort of thing. But it's a headache for sure in the industry.
No, that's helpful. And real quick, Stephanie, I'm going to go back a little bit to China based on a question that we received here on the screen. And it really relates to manufacturing from a pipeline perspective and the need for China moving forward. And how much do you think there is that need moving forward?
I think that it's been a massive theme over the last 3 years during COVID. Companies, for the last 25 years, companies have been outsourcing to China because it's so cheap. And so they put all of their supply chains, they were very dependent on China. And then all of a sudden, China's closed, and then we're closed, the world is closed, and then China opens, and then it closes again. And the headaches that it gave a lot of the US companies, any company around the world, because they just couldn't get the products. And so you have seen a massive shift towards diversification. Unfortunately, it takes a really long time to build a plant. Right? It takes about 3 years, but just the semiconductors are a perfect example. A semiconductor fab equipment company, if they want to build a plant, it is 5 years, and that's a long time. So eventually we will have more supply chains here and less in China. And I do think you are seeing companies pull out from China, going not only here, but going to Japan and going to Europe. If you look at the Japanese market, year to date, that market is up almost 20%. That is huge. And I think a lot of that is because they are seeing the beneficiaries of companies shifting their manufacturing around the world. And a lot of them are going to Japan. And that's also a theme for that country too. But it's a very big deal. It's going to take years and years for companies to get this right. By the way, it's a heck of a lot more expensive to have a manufacturing plant here in the States versus in China. So that eventually, so while it's great for our economy that we're seeing all of this infrastructure build here, it's going to hurt the bottom line and margins, I would suspect, down the road for companies.
Yeah, that's and this may be I don't know, a fair question, hopefully, but as you think of China and you look at the auto industry and you look at what China's kind of really diving into from the electronic car market, what's your kind of vision of the auto industry as we move forward?
Oh, I mean, I think they're under massive, massive change, right? This is interesting. I was listening to a company called Freeport-McMoRan. They're a copper company. Well, copper is the number one input that goes into an electric vehicle. And they said that China demand was much stronger than what the headline numbers have been coming out, right? We were hearing all of this this slowdown and the reopening is not working and this and that. And they said it's booming over there in terms of the EV market. So I thought that was very interesting. But yeah, no, I think the auto industry is going through an enormous amount of change. I think EVs. I know everyone likes to talk about Tesla, and it's an amazing company, but there's so much competition that their margins have just collapsed because they've been cutting price. And so have GM, so have Ford, so have a lot of the companies that are getting into the EV space. So I think it's going to be a long time before we do a big switch over from the traditional autos to EVs. It's definitely happening, but only 6% of the cars in the U.S. are actually EV. So we've got a long way to go. And I think a lot of competition along the way. So as an investment, I'm not crazy about it, but I do think it is certainly something that we're watching technology take over right in our front, right in front of us.
Right, exactly. And this is probably, thank you. This is probably a good one because I know we're getting close to the 45 minutes here. But maybe a good way to kind of end towards here is, what's your primary takeaway is the question for the economy right now and through the rest of the year? You mentioned a lot of this stuff up front, right? And everything that we've seen move here in the last 6 months. Kind of, what's your view overall as we move through the rest of the year?
I think it's going to be slow growth. I do not expect a recession. I think that there's just still too much stimulus in the system, which, by the way, is a good thing. It's a good thing, but it's not totally offsetting the higher rates from the Fed, but it is adding to a lot of tailwinds for certain parts of the economy. So I expect the consumer to stay strong because I expect the job market to stay strong. I do think inflation is coming down, and I think you're going to continue to see it coming down. But the question is the Fed happy with like a 3% kind of inflation number, or do they really want to overshoot their 2% target? Do they want it to get to 1%? And then therefore we normalize, and then you get to, then you kind of gradually start to ease and that sort of thing. So we really have to watch the Fed. But if I'm looking at one thing, I'm looking at the job market, as we talked about, because that's going to be if that starts to crack, that is your tell that the consumer, I don't think they collapse, as I said before, but that will slow things down a bit. And then of course we have to all watch inflation because that's important. But I think companies are going to do a better job at restructuring if they need to, price increases, pricing power if they need to, free cash flow generation, hoarding if in fact they see a slowdown. They're not as of now. And earnings have been better than expected. And I think that that's what's going to be the case. If the economy hangs in, like I think, 1 or 2% kind of growth number, if the economy hangs in, earnings will hang in. And if I can tell your clients one thing, it's stocks follow profits. Okay, so if profits are going higher, stocks tend to go higher. May not be 1-to-1 immediate, but they do. When profits go lower, stocks go lower. And so that's why it's so important to watch the economy, earnings, stocks. And I think you're going to continue to see kind of a drift higher in the market because earnings are going to hang in there. And I know a lot of people are expecting a lot lower profits. So I might be a bit out of consensus, but I feel pretty good because I do listen to a number of companies and their conference calls. Whether I own the stocks or not, I just like to learn, and they tell you all kinds of good stuff.
Right. Well, and people should be aware. I mean, you're literally speaking to the CEOs of these organizations, very
Yeah.
often.
And this morning, I was actually asked to be on GE's manager call. They had 600 senior managers around the world that they do a quarterly call, just an update, and they wanted to know, what do I think of the company? And it was really a very special time. So yes, they do pay attention to people on TV and what we say and what we own and what we don't own, and that's sort of fun. I wouldn't personally own a stock if I didn't meet or know the CEO in some way, shape, or form. That's just my style, and I'm lucky. I'm so fortunate that I get to meet them.
Yeah.
Yeah.
And last question, how and I know the jury's still out, but how do you grade the Fed so far on the actions that they've taken?
I give them a D.
Yeah.
I tell you what, I give them an A+ for May 2020, an A+. They acted brilliantly when we shut down the economy. They did the right thing, but they got caught up in transitory inflation, and they were talking like a year ago, they were talking about, we're going to have to start a rate hike cycle. And at the same time, they were still buying bonds. So I think, they're behind the curve again. They should have started to tighten a long time ago, 2 years ago, but they didn't. So now they're fighting this. And now I think they're overdoing it on the upside, but we shall see. Maybe I'm hopeful they can engineer a soft landing. I can just tell you, as I started the conversation, we are in a soft landing. So now they should probably pause, but I don't think that they will, unfortunately. So I think 1 or 2 more rate hikes, and then they'll say, okay, we're going to assess the situation, but we're going to keep rates high. And so we'll have to see how that impacts the economy. But again, all the more important for your clients to talk to you, because you have relationships with all kinds of people, to hear what's happening in the economy, and talk to people like me who run money and talk to companies that are all around the economy and can give you kind of little tidbits as to real time what's happening.
Thank you. And I asked you this question last time, and I see all the books behind you, and Stephanie's an avid reader. What are you currently reading, Stephanie? Because I actually, after our conversation last time, I had a few people ask the same question. So
is that right?
Yeah.
I've just finished, and it's an old book, but Maestro. And only because we're obsessed with the Fed, and this is so wonky that I'm sure your clients aren't going to want to read this. But I just wanted to learn a little bit more about the Fed and Alan Greenspan when he was the Fed chair and how he went about his business. And I learned a ton. I think you can learn a ton with any Jamie Dimon books. He's the CEO of JP Morgan.
Yeah.
Whether you own the stock or not doesn't matter. But I find learning about, as they say, the Fed is one thing that's very drilled down focused, but to learn something from a banker who has so many pieces of their businesses in the economy, you can learn so much. And I find when he writes his own books, they're very simple. And that's what I've always liked about him. He's just very transparent and very easy to understand, because banks aren't easy to understand.
Yeah, that is true.
Yes. So those are the two. And then I read Barron's every week. That's the religious weekly due diligence that I do.
Well, Stephanie, thank you. It's always time well spent. Always appreciate your insight. To everyone that joined us today, we appreciate you taking a few minutes of your day to spend with us. This has been recorded, so it will be posted to our YouTube channel. And if you have any other additional questions, do not hesitate to reach out to your wealth advisor. And we look forward to another 6-month check-in, Stephanie, as we get to the end of the year. So thank you, everyone, for joining us today.
Thank you, Bill.
Take care.